Okay. Can I now start, Annalena?
Yeah, you can start talking whenever you want.
Okay. Hello, everyone, and welcome to today's webinar. My name is Monica Bechtel, and I am with the New Mexico Small Business Development Center. Today, we have Amanda Davis joining us, who is a certified SCORE mentor, holds a bachelor's degree of business administration in accounting, and is the founder and owner of a business consulting and a bookkeeping firm here in New Mexico. Amanda has guided many small businesses, creative professionals, and nonprofit organizations towards financial clarity and will be presenting basic bookkeeping. We will be using the Q&A function to take questions and welcome attendee participation, so don't hesitate to ask us any questions you may have. We will answer questions at the end of the webinar. This slide features some COVID-19 business resources links, which I won't go over in details, as we will send you a copy of the presentation at the end of the webinar. Please visit our website at nmsbdc.org to view our upcoming no-cost webinars or to sign up for our no-cost counseling services. I will also send a follow-up email to you with this information. Thanks so much for joining us. And without further ado, I will hand it over to you, Amanda.
Thank you, Monica. All right, everybody. This is the basics of bookkeeping, basically. So I'm just going to jump into what we're going to do here today. The outline of this presentation is basically we're going to get into the accounting principles and bookkeeping. Why would you do bookkeeping? What are the practices? Financial statements and ratios, top mistakes that you can avoid, hopefully. Terminology and reports. Now, we're going to run through this kind of fast. If you haven't had any experience with bookkeeping, this might feel like drinking from a fire hose, but you will get a copy of this presentation so you can go back, and this video is also being recorded so you can watch it again later. The training objectives is understand the process and purpose of bookkeeping, understand why bookkeeping is important, understand bookkeeping and accounting terminology, understand basic financial statements and basic financial ratios. Now, the history of bookkeeping. Modern bookkeeping was formally established in the late 15th century with a mathematician and a monk. In their books, they actually wrote a book where they described the double entry bookkeeping system. And so while the basics of accounting has not changed, the practice actually has. So basically, the double entry accounting system has transactions that are recorded in two separate places, known as the journal and the ledger. The books are then to be balanced each month. This is known as a trial balance. And this is done before statements can be prepared. So now that we have accounting software, we're not manually recording things in a paper journal, right? Now we have software that helps us do it. So we have different resources like optical character recognition, OCR, bank feeds, where the accounting software can really actually be connected to your bank and pull in information from the bank, transactions from the bank, so that you do not have to worry about manual data entry and data entry errors. You can create rules within accounting software. The rules where you can say, hey, QuickBooks or Xero or whatever platform you're using, if a transaction has this name in the description, please code it this way, and the system can actually do the work for you. So there's a lot of resources there. Now, accounting versus bookkeeping. So bookkeeping has a lot of record keeping and data management. So when we're talking about record keeping and managing data, we're probably want to look at, well, how long are you going to keep those things, right? And so the 3-year rule would be any kind of general correspondence, employment applications, any kind of internal audit report if you're big enough to have an internal audit department. 7 years would be bank statements, canceled checks. If you're not familiar with that term, when you write a physical check to a person or a business, when they go to their bank and cash that check is then canceled as the funds were produced to pay that check. So that is what a canceled check is, literally canceling out the check you wrote. And in the good old days, you would get a copy of those checks back. I don't think that's a standard practice for a lot of companies anymore, but that's what that means. Contracts, leases, expense reports, invoices that you send to customers, invoices that you receive from your vendors, personal records like timesheets and sales reports. So those are the 7-year record keeping bucket. There are certain things that you never want to get rid of. And that's basically your tax returns and your work papers. And you've heard the 3 rule, the 7-year rule for your income taxes. There's a certain amount of time that the IRS can really come back to you for general errors and looking into it. But those tax returns and work papers could be useful going forward, even if they're 10 years, 20 years old. And depending upon what the nature of the inquiry with the IRS might be, or your state taxing authority, having those records permanently is a good idea. All right, now, and the whole point of all of this with the bookkeeping is to make sure the information in the books is accurate, and it is also reconciled to these other places like your bank statements, reconciling your bank account to your bank statements to make sure your internal records tie to what the bank does, and you have that control in place. Now, accounting is a little different from bookkeeping. Accounting, you would take what the bookkeeper produces to summarize the business's financial position and render financial advice. You can prepare the tax return for that. You can utilize the books for audits. There are different levels of audits, and certified financial statements that maybe a lender or a buyer or an investor might look into. Common bookkeeping tasks is, making sure the data is entered from a source document, from a receipt, a bill, an invoice, etc. Office management, billing customers, paying bills, processing payroll, end of period closing, which is the reconciliation. We've talked about that. You may have adjusting journal entries that you might use. An example of an adjusting journal entry would to be maybe record depreciation if you have depreciation on the books, to review the financial statements, and then to lock the books, because once they are finished, you don't want them changing. Internal management reports, balance sheets, which is your assets, liabilities, and shareholders' equity. Your income statement, which is your income minus expenses to give you your net profit or net loss, depending upon how the period went. The cash flow statement, which reconciles the income statement to the balance sheet. Where did the cash go? And accounts receivable and accounts payable. So meaning if your customers owe you money, you've sent them an invoice and you've given them some time to pay, that accounts receivable report would show who owes you and how long have they owed you. Same thing in reverse for accounts payable. I'm going to pause here. I see we have some stuff in the chat. So I'm just going to go in and see if there's anything I need to address in here. It does not look like it. Yeah, and speak up, put questions and comments. We will continue to take this on and go forward. All right, top mistakes and how to avoid them. It's nothing more terrifying than looking at your screen like that, right? Okay, so the SBA has statistics that most new businesses fail within 5 years. Now, the reason why businesses fail, there's a lot of reasons, right? But if you're doing your books, you're going to know that you have a problem, and then you'll have enough time, hopefully, to do something about that problem. If you're not doing your books at all, you will be blindsided. So a lot of mistakes to avoid is not even doing any bookkeeping, not even looking at it, which is easy to do because you don't understand it, right? It's not the most exciting thing in the world, and you have a lot of things to do, but it's a big deal. You could pick the wrong accounting method. There are two different types of methods you can use. One is cash basis, meaning you record income when the income is received, and you record expenses when they are paid, not before. Accrual is kind of the opposite. When you record that invoice and you send it off to your customer, on a cash basis, you don't record that revenue until your customer pays you the cash. But on an accrual basis, you have earned the revenue even though you have not received payment, and therefore you recognize the revenue then. So that's the concept between accrual and cash basis accounting. Using the wrong accounting method could produce different results, and that might change some of your management decisions, investing decisions, creditor decisions. It actually might have tax implications. So the proper accounting method is important. Commingling personal and business expenses. It's really common for early business owners to pay for things out of the business account or pay for business things out of their personal account. And at the end of the day, it's a nightmare to track if you're putting personal expenses in your business account or business expenses largely outside of the business account. Having to go in and identify those and figure everything out is not only just a headache, but there could be liability issues, because if you're trying to say that the business is separate from the personal and something happens for a civil action against you, if you have personal transactions in your business account, it's possible that the people going after you could say that you have pierced the corporate veil. That's the legal business accounting technical term, piercing the corporate veil, meaning you're using the business as a personal account. So therefore you have not separated them, and they shouldn't either. And what that means from a legal liability standpoint is if they win, they could take your house. They could go after everything you own personally. It would not just stop at the business. So it's a big deal. It's a big headache. Get a separate bank account, get a separate credit card, get a separate PayPal account, please. Venmo, everything separate from your business and personal. It will make your life much easier. Misclassifying workers. So this is important if both from the federal government standpoint, but also from a state and local side. If you have an employee and you're calling that employee an independent contractor and giving that person a 1099, you could be in some big trouble there, because the federal government and even the state separately can come in and say, no, that's not an employee because of these rules, these tests. They don't meet the independent contractor qualifications. We're going to go back and reclassify this person as an employee. And now you have back penalties and interest and taxes and payroll stuff to file. And you've got to go clean that up. And that's annoying. And you really do not want the Department of Workforce and the Department of Labor upset at you as a business, as an employer. So misclassifying workers can be a really big deal. Not reconciling things. A lot of people would tell me, hey, I've got a business. I go online. I have a mobile app. I can see everything that's going through. Like, why do I need to reconcile? I know what the balance is. I know everything's good. Why should I reconcile? And the answer is, that is your first step of internal controls. You absolutely need to reconcile. First and foremost, to make sure you don't have duplicates, to make sure you don't have omissions, and to make sure you don't have errors. So once you reconcile those three things, you can say, okay, cool. The data that happened is in there. There's nothing incorrect or missing or duplicated. Yay. Now we can actually use the reports. Another thing is when I was going in to reconcile a client of mine, on their website, they were able to let their customers pay them money through their website. And a hacker went in and did a number of transactions. And those fake $1 transactions that they processed, I don't know, maybe 2,000 in half an hour, had real merchant service fees attached to them and actually cost the client real money. And the client didn't notice. I went in and found that for them. So this is why you pay attention, and this is why you reconcile. Okay, lack of controls. You don't want money just lying around, so it can go missing. My dad's company had paper checks that they would print out for the business, the formal printed checks. And somebody had gone in and taken checks out of the middle of the stack. So people didn't know it was missing because the check numbers were clearing in order until later on down the road. And yeah, that was a big problem. So controlling access to your assets and your business is a big deal. You need to do it both for physical assets, but also financial assets and intellectual assets. So you need to have good controls in place. A lot of business owners misunderstand the difference between what is profit and what is cash at the end of the day. So a lot of people think, oh, well, I have this much money in the bank, that must be how much profit I made. And that's not the same thing for very numerous amounts of reasons. But one, for example, is depreciation. You buy a car and you're not allowed to deduct the car all in 1 year. You have to take it over several years. And so you have to allocate that cost over several years. Well, the cost went out the door on the first year, but that's not your net profit because you couldn't take that whole thing. So that's one example of why they're different. Another example is taxes. You got to pay taxes, and you're usually doing that after the fact. Like you've already recorded your profit, and the next year you go in and you file last year's information, and then you have to figure out how much taxes you owe if you haven't paid in enough, so on and so forth. So there's so many reasons why your cash at the end of the day is not the same thing as how much you made money during the business or lost money. So it's not a matter of profit. Cash is very different. DIY bookkeeping could be considered a mistake if you're A, not doing it, or B, doing it wrong. So it's a good idea for you to understand it and know it, but pay attention and make sure you're getting it done properly. Otherwise, you're not doing yourself any favors. No record keeping at all is probably one of the worst things that you can possibly do. Just for the simple fact of the matter, if you have the IRS or your state taxing authority coming to you and they see money in the bank and you're like, oh, no, I just put money in the bank, but you can't prove it. You can't say, okay, this is an owner contribution, or you had a cash expense where you bought something big, but the person you bought it from wanted to be paid in cash. If you don't have receipts, you don't have documentation, you don't have a leg to stand on. The IRS and the state taxing authorities is going to see that cash and they're going to say it's taxable. You can't prove it otherwise, so that's what it is. They're going to see that cash transaction and they're going to be like, there's no receipt. You can't prove the business purpose of paying that money, so you do not get to deduct it. You got to pay for it, but you got no benefit for paying for it. So hopefully you like what you bought, but when it comes down to your taxes, we can't reduce your taxable income based on that. So keep records. It's a really good idea, whether you're doing it in paper or digital or both. Make sure you keep good records. And many of the accounting softwares will allow an app on the phone where you can take a picture of a receipt. You can use things like Dropbox or Google Drive or whatever you like, or just buy an accordion file and file stuff away if you like paper. Insufficient checks and balances, that's improper controls, making sure that you have the right amount of things in place to prevent bad actors from doing bad things to your business. And a lack of an audit trail is very similar to record keeping, making sure that you can go and figure out who did what, where, when, and how. Because if you've got a problem, going and figuring out how that problem occurred is really important to being able to figure out how it never happens again. So that's one of the things. All right, terminology. This is going to go a little bit fast and furious. Again, you will get a copy of this presentation, so you will have all of these terms. You can go look them up. I didn't put the definitions on here on purpose. I want you to go through the process of seeing it multiple times, having different definitions explained to you from different various sources. So I'm just going to dive in here. So the accounting equation, you're going to hear this a lot from me today, is the key formula that keeps your books in balance, which means your total assets equals your total liabilities plus shareholders' equity. So I actually have an image of this that will hopefully help you see that a little bit better, but Assets equal liabilities plus equity. You can see the accounting equation in action in your business on the balance sheet. Accrual versus cash basis, we went into that. Accrual means you record it when it is earned and or incurred. Earned is the right term, and incurred is the right word too. Whereas cash, you recognize the money when it comes in and out. You don't say, okay, I have an invoice that is taxable revenue for me today, even though the client hasn't paid me. And as a cash basis, you do not recognize that money until the client pays you. On an accrual basis, you recognize and pay that taxes before you get paid. So there is that. You ask why you would do one over the other. There's lots of different reasons. So that's a conversation for probably a more intermediate course, or a discussion with your tax person to see which way makes the most sense for your business. Which one is the most advantageous for your business, because there are benefits and drawbacks to both, and it all depends on your business. Assets, what your business owns. Assets include cash, buildings, vehicles, patents, open invoices from customers, that's accounts receivable. Those are just a few of the things that are assets. The accounting period is length of time it takes to complete an accounting cycle. Accounts received is monies that are owed to the business by others. This is a current asset. Accounts payable, monies that you owe to others. That's a current liability. Accruals is income and expenses incurred but have not been paid. A balance sheet is a comparison of all of your assets, equities, and liabilities. Cash flow is money that comes in and out of your business. There's various reasons and processes and statements and ways you look at that. Chart of accounts is the listing of categories you use to classify your business transactions. Think of your chart of accounts as a sort of filing systems for your business transaction. An example of a chart of account is a bank account. It's meals and entertainment, it's office supplies. Those are the different chart of accounts that you would use to categorize each transaction as it occurs. Cost of goods sold is money your business spends directly to produce income. Double entry bookkeeping, we talked about that, where transactions are entered twice. You enter one as a debit and one as a credit in the journal and the ledger. Debits and credits, each bookkeeping transaction has two sides. One side of the transaction is the debit, the other side is credit. Assets and expenses are increased by debits and reduced by credits. Income, equity, and liabilities are increased by credits and reduced by debits. You don't have to know this. Many four-year degree accounting students actually have a little trouble with this coming out the gate. But the more you practice and understand the systems, the more you say, okay, I want to increase the balance here. Is it a credit or is it debit? And it really depends on, well, which account are we talking about? Depreciation, the write down of value of capital assets over time. Equity and capital, what is owed to the owner or shareholder of the business. Equity includes money paid by the owner, which is a contribution. Money the owner has earned but not taken from the business, retained earnings, and other type of contributions like stocks issued. Fixed asset, these include land, buildings, machinery, equipment, vehicles. Fixed expenses, these are things, these must be met regardless of the level. So a fixed expense is very much like rent. It doesn't matter how frequently you're at your office, you're going to pay rent. You're going to pay the same amount. It doesn't matter how often you use it. Now, there's a thing called variable expenses, which is the opposite, but that is at the end of this alphabetized list of terms. General ledger is a ledger made up of assets, liabilities, equity, income, and expenses. These 5 types of accounts comprise your books for your business. A journal, the daily business transaction recorded there before they go into the general ledger. Liabilities, what your business owes. Liabilities include credit card balances, amounts due to vendors, accounts payable, loan balances, tax liabilities that have not yet been paid. Income and revenue is your sales. You can sell goods or services. Payroll is a list of employees and how much you pay each one. Profit is what your business has earned after cost of goods sold and expenses are subtracted from profit. Profit is not the same as cash on hand. Reconciliation, the process of verifying the balance of certain accounts, checking, credit cards, loans, etc., against the statements from an outside source, usually a bank. And on we go. Subledger is a ledger containing a detailed subset of transactions. The trial balance is a statement that tells you if your debit and credits are accurate before you create financial statements. And we move to variable expenses, which fluctuate with the level of use. So if a fixed asset is rent, a variable expense is utilities. You pay for exactly how much you use. So those expenses vary from use. So the more you use it, the more you pay, the less you use it, the less you pay. I'm going to pause here real quick because I see a few things in the chat. All right, where can we find all of these definitions and terms? Yeah, it's really fast. Unfortunately, we can't spend a whole lot of time on these terms. These terms will be provided to you. You will get a copy of these slides. You can go to your community college. You can go to the SBDC's office and request a mentor. You can use SCORE, or there's different other organizations that could sit down with you with terminology. And honestly, if nothing else fails, I can't tell you how often I Google questions as a business owner and how often I go to YouTube to watch a video. So there's tons of information and resources out there, and for you to be able to kind of go through and do these definitions. And I didn't put these definitions all the way down, just the terms, so that you go through the process and go through the process and look up these definitions, because they are stated differently from different places. And yes, this is being recorded and you will get a copy of the slides. All right, moving on. I apologize for the rapid fire of terms. Again, you are going to get a copy of this. And if you have any questions about this, you can reach out to the SBDC for further resources. Okay, financial reports. We're just going to dive right in. These are the different financial reports we're going to go over today. We have the balance sheet, the profit and loss, the aging reports, and the cash flow statements. Now, the cash flow statement, what we're going to go through here is the statement of cash flows. What you might be thinking that we'll be doing is going through and doing like a projection of cash flows. We're not doing that here. That's a different resource and tool for you. And again, the SBDC has lots of resources available for you. The cash flow statement that we're going to do here basically comprises how the money moved in and out of the business and what that movement represents: operating expenses versus financing versus investing. So a little bit different. This is more of a traditional financial report that you would run in QuickBooks or Xero or whatever platform you might be using. The balance sheet has assets, liabilities, and equity. Profit and loss has your revenue. It's also called the income statement. It has your revenue, sales, cost of goods sold, expenses, and there's other income and expenses that may not be in the ordinary course of business that might flow through there. Aging reports, accounts receivable and accounts payable aging reports. The aging reports would be a complete listing of all of your customers for receivables. Say you have all of these customers that you have invoiced, but they have not paid you. Then you would go and see, okay, how long have those been outstanding? Are they 30 days? Are they 60 days? Are they 90 days? Accounts payable is the same thing in reverse. It's for people you owe money to. Accounts receivable is people who owe you money. So you have it on both sides. And then the cash flow statement is, it shows you cash receipts, cash disbursements, and cash on hand at the end of the month. All right, here's the visual of the accounting equation. When we said total assets equals total liabilities plus total shareholders' equity, then this gives you a complete example. The bucket of assets is the same as this, what equals the total liabilities and equity. So total assets equals total liabilities plus equity. That's why it's called a balance sheet, because it does in fact balance. Now, the things that come on a balance sheet are your bank accounts, operating accounts, savings accounts, money markets, any of those kind of things. Accounts receivable, where you have invoiced customers, but they haven't paid the invoice. Fixed assets like equipment, vehicles, buildings, that kind of stuff. And now we have some new terms as current and long-term. So current assets and long-term assets all goes around timing. And the timing is usually within a 12-month period. So if you have something due within that you can get access to quickly within 12 months, it's a current asset, which is why receivables would be considered a current asset, because hopefully you do not give your customers longer than a year to pay you, other than you're not in, if you do that, you're not in the business of selling things, you're in the business of financing things, and that's a completely different business. And long-term assets would be stuff like you can't get access to it for longer than 12 months. So a CD at a bank, where you invest some money and you get a CD. CDs come in all kinds of different sizes and terms. And some CDs are 6 months and some CDs are 18 months. The 16-month CD, because you can get access to it within 12 months, that is a current asset. The 18-month CD, well, that is a long-term asset until the period gets closed in within the 12 months. Liabilities, let me go back to the chat. When I say cash, that means physical and digital money coming into your business. Yes, that's actual money in the bank, however that looks. I'm not getting into cryptocurrency or what is it, fungible transactions, non-fungible transactions. We're not going that far here. But yeah, cash is money in the bank. Somebody paid you money somehow. You either received it, they paid you with a credit card, a debit card, cash, whatever. Okay, so we're moving on to liabilities. Accounts payable is kind of like your utility company. P&M sent you a bill, but you haven't paid the bill yet because the bill's not yet due. So that would be an accounts payable because you owe the money, but you haven't paid it yet. Credit cards, very similar, lines of credit that you would get through your bank. And there's other different lending institutions that would afford that. Different kinds of loans. And again, we get into what is a current loan versus what is long-term loan, meaning you have a line of credit that would probably be a current liability because they're going to want you to pay that off in less than a year. A long-term liability would be more of the EIDL, where you've got the economic injury loan that is due like a mortgage over 30 years. So clearly that would be a long-term. Shareholders' equity is also called retained earnings. It's also called members' equity. It's also called capital. There's a lot of terms, but in this bucket is basically what the owners own of the company. It includes, if you're a corporation, common stock, additional paid-in capital, retained earnings, owner contributions, owner distributions, all of these things. We're going to move on to the next slide here. Okay, now, because I know that you can't go home and go to sleep at night without seeing numbers on a sheet of paper. Like, we haven't got to the exciting part of this until we've really introduced numbers on paper. So here we are at that stage, and we're going to do it for all three different kinds of reports, or all the different kinds of reports. For the balance sheet, because of the equation, and I'm really trying to drive this home, because there's three things that comprise the balance sheet. I've broken the balance sheet up into 3 slides here, but when you see a balance sheet, it's going to have all 3 on one sheet of paper. So right here, we're just focusing on the assets. That is the first part of the equation. And this is an example. I pulled it off of Google. And this is T-ball bat and gloves balance sheet from 2008. So we are very current on these numbers on paper here. And the assets, we have current assets, we have cash, accounts receivable, inventory if you sell products and you keep products on hand to sell. Plant and equipment. Plant is kind of an old school term for like property or facilities. It's a building that you own. And depreciation is taking that value over time because you couldn't just deduct it right then and there. So this is basically what the asset side of your balance sheet would look like. And then this is the liability. So this is things that you would owe money to. And so we have current and long-term and other types of things here. So accounts payable, if you have credit cards, any kind of accrued expenses, that you owe, but you haven't paid yet. If you're an accrual basis, if you're recording things on an accrual basis, then you may have unearned revenue, meaning that a customer gave you a deposit, right? That is a refundable deposit. So until you do the work or you meet whatever requirements that have been agreed upon, that money is not yours yet. And so that's where that would live if you're on accrual. And then long-term versus short-term. So you would put in your line of credit in the current liabilities and your EIDL, the economic injury loan, that would be in long-term debt. So we'll keep going. And this is the equity section. So this section is an example. Monte Corporation is a corporation. This is a C corporation with shares, possibly a publicly traded company, who knows? But if you're a partnership, this might look a little bit different. If you're a single member LLC, that might look a little different. If you're an S Corp with only one shareholder, that might look a little different. But from just a visual standpoint here, I can't show you all of them. I don't want to confuse you too much. Hopefully I'm not. But this one is for corporation, where they have paid in capital, and they have it in the form of preferred stock and common stock, and they have more terms like cumulative, non-par, so on and so forth. So you can go and look up more terms. I kind of hit them back in here. But those are real specific to corporations. Your retained earnings, which is the accumulation of the ownership amount that kind of rolls in here. Total paid in capital and any kind of treasury stock, and then you have a total equity. So assets equals liabilities plus shareholders' equity. So this is the equity section. And here we go with the equation again. Assets is what you own. Liabilities is what you owe. Equity is what you get. So hopefully that's pretty clear here. All right. Then I love this little this little cartoon here for aging reports. So we're gonna look at accounts receivable and accounts payable aging reports. And basically the idea here is to identify if you've invoiced people and they haven't paid you, who owes you money, and how long has that been outstanding. So in here, this cartoon, if an invoice is due in 30 days, we pay it in 60. If it's due in 60 days, we pay it in 90. If it's due in 90 days, they probably don't need the money anyway, which is not really accurate, but I just think that's hilarious. And then the accounts payable is people you owe money to, like your utility company. They have sent you a bill, you haven't paid it because it's not due yet, but you still owe the money. So you would say, okay, who do I owe? How much do I owe? And how long has that been outstanding? Hopefully everything is current because you're a good business owner who manages their finances and pays their bills. That would serve you really, really well. Okay, now we're going to go into the profit and loss, also called an income statement. And this is everything you sell less things that you paid directly to get those sales. Then you have operating expenses, things that happen just because you're running a business but are not directly contributable to a specific sale. And then you have other income and expenses. So we'll kind of walk through this. So revenue is your sales of products or your services. You can get commissions or any other way you make money in the ordinary course of running your business. A cost of goods sold is, for example, if you sold t-shirts and you bought t-shirts at a wholesale lower cost, and then you turned around and sold those t-shirts at a retail higher cost. The wholesale cost of those t-shirts would be a direct cost of the sale of the t-shirt because you had to buy the t-shirt to sell the t-shirt. So there's a direct correlation. That would be a cost of goods sold. So the t-shirt example is really easy to understand. The cost of goods sold can include things like materials. They can include labor if you're directly building out materials for inventory. If you have to pay to get those t-shirts mailed to you, freight in, and any other costs that are directly associated with the specific sale. Operating expenses are things that happen whether you make a sale or not. You have to pay rent if you have a physical location. You have to pay for advertising and payroll and office expenses, utilities, and all of these other things. Other income and expenses are things that happen because you're in business and you're operating, but not directly related to your operations. So for example, if you have a bank account, like a CD or a savings account that pays you a little bit of money in interest, well, that interest that you made has nothing to do with what you do for your business. So it's not an ordinary course of being in business. It's just this happens because you have that account. So it's in this other income bucket. Penalties and settlements. So let's say you filed your tax return late and you got charged late penalties and interest. That's where that would live. And the whole concept there is you should have filed it on time and you should never have incurred those expenses in the first place. So they would not be an ordinary course of business expense. And there's other things that kind of go in there. And then your profit and loss, well, you take your total revenues, then you reduce it by the cost of goods sold. You further reduce it by your operating expenses. You add in any of the other income items and you reduce that by the other expense items. And that is where your profit or loss lives. And again, it's not cash. These things are not the same thing. And so your profit or your loss, depending upon if that number is positive or negative, that tells you, did you make money or lose money? And that kind of gives you an idea. And then here's an example, numbers on paper. I try not to disappoint. So you see the profit and loss here, example of sample products company for May 2018. And they had $100,000 in sales and they had $75,000 in direct costs to achieve those sales. So a new term, gross profit, the difference between the sales and the cost of goods is the gross profit. And that is kind of your base starting point. And that number can be used to help you with metrics and understanding how your business works. At the end of the day, sometimes selling more makes you more money and sometimes selling more makes you less money. And this directly tells you that. That's one of the reasons you might use this. Then you come down to the operating expenses and they have all kinds of different things that go in through here. And then you have your operating income, which is your gross profit less the operating expenses. And then you have all this other income and expense bucket. So interest revenues, let's say you sold something and you had a gain on that sale. Interest expenses, hopefully you did not lose a lawsuit or were ever sued in the first place, but that's where that would land. And then you would have your net income here. And if you're at accrual basis, whether you paid out that lawsuit, you would probably be recording that here because it's owed, right? Until you can maybe get it off the books somehow. Maybe you can appeal and win or not appeal, who knows? Then we're going to move into the cash flow statement. So the cash flow statement here, it's basically saying money came into the bank, money went out of the bank. How did that money move and what was it used for, right? And so things here for this particular statement is operating activities. So basically everything from your profit and loss, right? Your sales, your interest income, cost of goods sold, operating expenses. Investing activities would be if you like bought a new vehicle and money went out, you put out a down payment, that would be investing. Accounts receivable, accounts payable. These are things that haven't, the money is owed but not paid yet. Financing activities would be debt, loans. Of course, you use loans to finance things, stock repurchases and dividends. So fun little statement of cash flows. And again, numbers on paper, not to disappoint. Here we have what's one of the versions of the statement of cash flows. There's a direct version and an indirect version. So you come in and work that through. This report is a standard report you would be able to run in any accounting software that you would use. Here you start with net income, depreciation, so on and so forth. So this is all the operating stuff, the total amounts that move for these different buckets. And then you have the investing amount, and then you have the financing amount, and then you have the change in cash, the beginning cash, the ending cash. So it's just kind of giving you an idea of money flowed in and out. How did it flow? What was the purpose of it? How was the money used, or how did it come in? So that this just kind of gives you an idea of that. Ratios. So ratios, this is not comprehensive by any stretch of the imagination. These are several financial ratios that are useful to your business. There will be others. Financial ratios are used by management for metrics if you want to build in goals. But okay, well, what does a goal need? It needs to be measurable. There needs to be a timeline. There needs to be a way to achieve it, right? You need to be able to go in and see, how are we doing on that goal? Are we meeting that goal? How did we do on that goal from year to year? And so these ratios can help you from a management perspective in that regard, but it can also help you understand, are lenders going to like you? Are you an attractive company to lend money to? Are investors, are you an attractive company to invest in? Like, how do these ratios work out? That's why the ratios are important. I'm going to go ahead and go through these, and then we're going to open it up to questions. And I don't think I saw any other questions or anything else. Please feel free to put your questions in the chat or in the comments, excuse me, and I'm happy to take them. Right now, we're going to start with break-even point. You may have heard this. The break-even point is the point where the income for the sale of goods or services exactly equals the total cost. So what that tells you is how much of your services or products do you need to sell to break even, to make no money. Why is that important? Well, that gives you kind of a base point to start from. Like, is this even a viable line that you want to do? Say you want to bring in a new product or service and you want to see if it's going to be any good, you're going to have to look at it and say, okay, how much of this do I have to sell to make no money? And at that point, does the market even support even that? And if the answer is no, then that is one of the reasons some businesses fail, because they didn't look at it that way. They didn't say, okay, this isn't going to work. So break-even point, the current ratio, measures the liquidity of the business, its ability to meet its obligation, those due during the course of the year, and it's your current assets divided by your current liabilities. Your debt to equity ratio evaluates a company's financial leverage, ability of the shareholder or shareholders or members or whatever to be able to cover all outstanding debts in the business in the event of a shutdown or a downturn, something that happened to a lot of businesses during COVID. So the debt to equity means you have more equity, hopefully, if this ratio is good, you have more equity than you have debt. So if you have to shut the business down, you can pay all of your outstanding debt. So this would take your total liabilities divided by your total shareholders' equity. A bank's going to look at that if they want to lend to you, because if you have more debt than you have equity, that's going to be an issue. Okay, the quick ratio. It's also called the asset test, an indicator of a company's short-term liquidity position and measures a company's ability to meet its short-term obligations with its most liquid assets. So basically, this is, it's basically saying, okay, you got these short-term assets and you've got these current assets and you've got these current liabilities. Can you convert these assets to pay for these liabilities if you had to do it? And how financially sound is that? Return on equity, it measures the financial performance, net income divided by the shareholders' equity. And the working capital represents a company's ability to pay its current liabilities in its current assets. So current assets minus current liabilities is the working capital. And I also included the gross margin here because in case you didn't understand the fixed cost divided by the profit margin here in the break even, this gives you that. So the gross profit margin here would be the equation that you would use to get to this number, and that would take your revenue minus cost of goods sold divided by your revenue. So that gives you an idea of what that looks like. And then I'm going to open it up to questions, thoughts, concerns. You have me until 3:30, folks. What is on your mind? What could I explain? What thoughts or questions do you have?
Amanda, there is one question in chat. When you say cash, this means physical and digital money coming into your business?
Correct. Yes. So that would mean if somebody paid you with a credit card, that would mean if somebody paid you with moving money from their bank account to your bank account. It would be if somebody paid you cash, somebody wrote you a check, any and all kinds of ways that money would go into your bank account. Are there any further questions, thoughts, concerns? Doesn't look like it.
Well, then I guess.
Hold on, I see one.
Mm-hmm.
Starter course with accounting and bookkeeping. There's a lot of them. The more affordable places where you can get a full traditional course, I would say would be maybe at a vocational college or a community college like CNM. That would probably be your more affordable options where you can just go and take a course, or it's a more formal traditional actual training course. But you can also get help. There's resources through, like I said, the SBDC. They have mentors available. They have all kinds of resources available. And there's tons of information if you're using a platform like QuickBooks Online. There's tons of videos on how to do certain things. There's businesses like my business that you can go to and hire them to help you do your own bookkeeping, help you understand it and learn it. So it's really kind of depends on how you would do it. A traditional four-year school, you've got to have prerequisites and you've got to go through their hoops and this, that, and the other thing. And I can tell you a traditional college course is going to give you the basic understanding of bookkeeping, but practically you're going to be a better bookkeeper by learning and doing. You're going to get out of college, and I can tell you more than 80% of the people I graduated with probably had no idea what a normal balance is. And what that means is I have to adjust this balance up or down. Do I credit it or do I debit it? And they couldn't tell you that. And so a school education is not really going to give you that, but it will help you with the terminologies. And that is that's a great start. But practically jumping in and going with it, hiring a bookkeeper, maybe an accountant to kind of help train you. That would be probably my best way forward with you. Also, the SBDC, like I said, has tons of resources. Okay. What is a recommended bookkeeping system program for a nonprofit or a church? I use QuickBooks Online exclusively. I use QuickBooks Online for both nonprofits and for-profit organizations. There's other platforms like Xero. I do not recommend Xero for the sheer fact that they do not offer a traditional bank reconciliation, which is your basic level of internal controls. Like that is your first step, and they don't offer that. But there's other accounting programs. There's Wave and some other things. So I would say if you're going to go with QuickBooks Online, sorry, the phone is ringing. QuickBooks Online is a great option, and but go with the business software. Don't go with self-employed.
We have another question. What would you suggest as the most simple financial record keeping software, and at what point is an accountant needed?
So again, I would say you can do it in Excel, you can do it on paper, you can go to Staples and buy green ledger paper. I'm not a fan of doing things manually because I don't think you'll do them. And it provides a lot of opportunities for mistakes. So I would get something like QuickBooks Online or Wave or Xero if you want to go that direction. But QuickBooks Online has a self-employed version that's cheaper. I would not recommend going with that. If you're going to go with QuickBooks Online, go with their one of their products that are designed for business. Even if you're a nonprofit, the business one would be suitable. Excellent.
Then we have another question. How do you figure out and deal with paying yourself an income?
That question can only be answered by understanding how your business is set up legally. So if you're a sole proprietor or a single member LLC that is filing on a Schedule C on your tax return, your personal tax return, then the way you pay yourself is through what's called an owner draw. And you can just take money out. You get no deduction for taking the money out, but you also get no tax impact for moving the money. The money is basically just like pulling money out of a bank account. So that is an owner draw. If you're a partnership where you have a partnership tax return that's separate from your personal tax return, or if you're a corporation, an S corporation or a C corporation, you might be looking at payroll, paying yourself through payroll. And there's different strategies for different legal things. And your tax preparer would probably be the best person to help you identify which one is actually going to be the most appropriate. When is an accountant needed? I kind of think they're always needed, but I'm biased. I would say, you know, if you're having any level of complexity in your business, if you're having trouble understanding it, if you're having trouble sleeping at night, you know, TurboTax and those type of softwares are really great, but are you sure you got everything? You know, paying an accountant might not be ideal, and it may not be even something that you can afford at first. But I think once you can build that in, having at least a professional tax preparer that can help you identify these things and do tax planning strategies is a good idea. If you can get a bookkeeper on board, that is great, but do not ever check out of your books. If you're hiring somebody to do your books for you, you need to know, you need to be able to look at those profit and loss reports. You need to look at the balance sheet. You need to be able to come in and say, okay, I understand what's happening in business, and you need to be looking at it regularly, even if you're hiring somebody else to do it. It's very important. Okay. Trying to see if there's anything else. Are you aware of any Excel templates that can help you with a balance sheet and income statement? I'm pretty sure Word or Office has templates for things like that. You know, and you can build them out. Doing it in Excel, I think, would be very meticulous and time consuming and unnecessary. I think using a software like Wave or Xero would be a better investment if you were able to afford that. And I think the smallest number is like, I want to say it's like $15 a month. And that's a business deduction that you can take as a deduction against your income and to reduce your tax liability. So something like that would make more sense to me than Excel. I've done them in Excel. It's a little bit painful, and you need to be pretty good at Excel if you're going to do it in Excel, because you would be recording all of your transactions. Then you would need to be reconciling all of those transactions to the bank account. So you'd have to build out a reconciliation, right? And then the ledger, and record it to all the chart of accounts. And then you need to create a pivot table to generate these statements and make sure everything balances and that you don't miss anything. I think there's just so much left to human error that you can do it, but I don't know that I recommend that. Excellent. Any other thoughts, questions, concerns? And again, this is being recorded. You will see a copy of it on YouTube and on demand, and you will also get a copy of these slides.
Well,
yes, you will absolutely get a copy of the slides.
Thank you for the presentation and valuable information, Amanda. Thank you to all the attendees, and have a wonderful afternoon and a week ahead. Please visit our website at nmsbdc.org to view our upcoming no-cost webinars or to sign up for our no-cost counseling services. The NMSBDC is here to help you during any stage of your business, so don't hesitate to reach out to us. Thank you and have a good day. Bye.